Well, we've got a big week for U.S. economic data. Markets are nervous with the latest inflation print out tomorrow. Retail sales out on Wednesday. We're going to hear from a number of retailers later this week. At the same time, you've got Fed members, including Jerome Powell, warning that another hike is on the table. And yet the market is pricing in the fact that we're probably done here when it comes to rate hikes. So tomorrow's inflation print could be the tiebreaker. Our next guest says we've got to get used to markets that will be sensitive and volatile. I'd like to bring in Youngwoo Ma. He's Chief Investment Officer at BMO Wealth Management in the U.S. Youngwoo, thank you so much for joining us. How are you thinking about this kind of recent rip off those October lows? Because in many ways, we went back to our reflex, right? Okay, we're worried about things like let's get back into tech, because at least in tech we can trust.
Yeah, there is a bit of that mentality for sure, because there's high uncertainty in the marketplace as some of the data comes in a bit choppy. There's uncertainty in the Fed messaging and what that's going to be in December. And you hear different things from different Fed members about what they think individually the path of interest rates might be. And even in the wake of Chairman Powell's press conference the other week, you had the 10-year Treasury yield falling quite precipitously. So there's a lot in play here. And as you said, I think the markets are kind of falling back on something they take a bit of comfort in, which has recently been technology.
And how do you think about tech exposure? Both, do you like the sector? Are you worried about concentration? Because increasingly, if you buy Microsoft or Apple, you're not just buying those stocks, you're buying a big chunk of the overall market.
We do like technology here, and it's true that there's great concentration and really unprecedented concentration in really just a handful or so of names in technology. But the reality is those names are also very well positioned to capitalize on future trends with AI, with network effects that they have, and the deep pockets they have to fund innovation. So we like the sector. It's hard to avoid this sector. But it's true, there's a bit of unease given the tremendous concentration that we have now in the space.
And there can be a temptation to look at less obvious parts of the market. You could, especially if you're looking for dividends or payments, you might look at the energy sector, you might look at the financials, which have received significantly less love. How contrarian are you willing to be in some of those sectors?
I don't think right now it pays to be overly contrarian. I think that right now there's a lot of uncertainty in the economy, and some of those sectors are down for a very good reason and face a lot of uncertainty still. And within financials, one thing we're seeing is that the big banks are gaining a greater share of overall profits. And so there's more stability in the big banks than there are in the small and sort of smaller regional banks as well. But I don't think it pays to be tremendously contrarian here. We do think that the S&P 500 overall, with that healthy weight to technology, is probably a nice place to be as a core portfolio holding.
So it's interesting you say that, because I want to apply that thinking to the bond market. And I think about that Barron's cover that said, stop crying about bonds, buy them instead. We have seen a big rally in the bond market. Do you want to follow that trade? Do you think we could see significantly lower yields from here?
We think yields are probably range bound here. The 10-year Treasury yield, which we use as a benchmark, has fallen back from the highs. It was pushing 5% the other week. It fell back to 4.5%, and now it's kind of bouncing in the middle there. We probably think that's what's going to happen through year end and maybe even into early 2024. So, we think bonds are attractive here. We like fixed income, especially the safer side of fixed income that doesn't have a lot of credit risk, whether it's very high investment grade corporates or treasuries. We like that because you get a nice return and you also get a lot of protection. But we think the yields are probably range bound here, maybe on the 10-year between 4.4 and 4.9, and we bounce around there for quite some time.
So that's interesting on the Treasury side, because there's so much complaining about, the supply, the issuance, about, the fiscal management at the government level, possibly another debt downgrade if Moody's decides to follow through on their negative watch. How do we reconcile that?
There is tremendous supply. It's going to continue through year end and even into 2024. So it adds an element of uncertainty because we don't quite know where supply and demand will meet at the end of the day. But we do think that the U.S. economy is still slowing down a bit, or is going to be slowing down over the next couple of quarters. So that makes that yield a bit more attractive. And we also think that global buyers are going to regain an interest given how high yields are. So we're pretty comfortable with the trading range here. But as we look toward, let's say, mid-2024, we think that continued supply probably is going to put upward pressure on yield. So we think we're range bound maybe for a few months or at most a couple quarters. But after that, we think we resume a bit of a march higher in yields.
I know you said that it doesn't really pay to be contrarian when you're looking at maybe equities as an asset class, but I'm wondering if that applies to geographies as well. The TSX has been such a frustratingly lagging market, a range-bound market. China, for example, has seen outright declines for the year. Is any of that piquing your interest?
Some of it. You do want to look at what is getting very negative in terms of investor sentiment. We do think China is probably a place where we're seeing some bottoming. Certainly, we think there's a bottom in sentiment. We think there's a bottom in policy, given the stimulus that the Chinese government rolled out a few weeks ago. And although the property sector is not bottomed, we don't believe that. But that does not mean that the equity market isn't searching out or feeling out a bottom here. Does that mean it's gangbusters from here on out? No, we think that it's probably a long road ahead, but we do think that there are at least some signs that with government backing and with stimulus, that the Chinese equity markets are again becoming a place where investors will start to look in 2024.
All right.